The average monthly car payment in America is over $750. That's $9,000 a year leaving your account just to keep the keys in your pocket. Most people look at that monthly number, check their budget, and stop calculating. But treating the monthly payment as your total financial burden is a trap. To see how the math actually works in 2026, we are going to look at a moderately priced $39,900 crossover, specifically a Toyota RAV4. We have to move past the dealership window sticker and look at the true cost of ownership. That means factoring in the entire financial life cycle of the vehicle. Start with your base yearly payment, then stack on insurance, fuel, maintenance, and loan interest. Over a typical 6-year loan, these additions, like $8,600 in insurance and $12,000 in fuel, push your actual outlay tens of thousands past the original sticker price. There is no universal right answer for how to pay for this. We have to map these true cost numbers directly to your specific driving habits. Financial clarity requires looking past your monthly cash flow and examining what the vehicle extracts from your net worth over its entire life cycle. Let's start with a standard 6-year horizon for our baseline $39,000 crossover to see an apples-to-apples comparison. If you buy the car, you put 20% down, finance the rest at an average 6.5% interest rate, and cover the cost of replacing tires and brake pads yourself. At the end of those 72 months, you hold the title to a physical asset that retains tangible resale value in the open market. The buying column totals your down payment, loan, and upkeep. Subtracting a 68% resale value gives a net cost of $47,000. Now, the alternative: 2 back-to-back leases, lower payments, and 0 out-of-pocket maintenance. But without equity, your net cost over 6 years hits $60,400. That is a difference of $13,386. You are paying over $2,000 extra per year to avoid maintenance and enjoy new technology. Over a 6-year horizon, leasing guarantees fixed predictability, but it forces you to pay a steep wealth premium for the convenience. Not everyone keeps a car for 6 years. If we compress the timeline to just 36 months, the math completely inverts. This chart tracks a vehicle's value. The drop is aggressive early on. Buying and selling quickly triggers the depreciation trap. If your car holds value exceptionally well, retaining 81%, buying beats leasing. But with average depreciation, residual value falls to 60%. When you try to sell or trade in that heavily depreciated asset at year 3, you absorb the absolute worst period of equity loss. Under those specific conditions, leasing actually becomes the mathematically cheaper option by nearly $3,000. On short timelines, the financial winner is dictated entirely by your vehicle's specific residual value. Standard financial models assume you are an average driver. If your habits or the broader economy deviate from the average, you trigger hidden multipliers. Standard leases cap your driving at 12,000 miles a year. Exceeding that activates an overage penalty of around 25 cents per mile. Say you are a heavy commuter covering 18,000 miles annually. Those extra miles generate an additional $9,000 in dead cash penalties over back-to-back leases, making the lease far more expensive than any buying scenario. On the buying side, the major variable is the broader economy, specifically the interest rate environment. Securing an 8.5% rate instead of 6.5% balloons your monthly loan obligation, costing thousands in extra finance charges and narrowing the buying advantage. Standard models are fragile. High mileage heavily penalizes the lessee, and high interest rates heavily penalize the buyer. The abstract mathematics only get us halfway. You have to map these numbers to your primary life goal. This decision tree maps out the 2 core paths: optimizing for maximum wealth building or optimizing for business and image utility. The pragmatic optimizer chooses a reliable vehicle that holds its value, buys it, and commits to driving it into the ground for a decade. Once the initial loan term ends, they enter a multi-year period of 0 car payments, which allows them to redirect that former monthly budget into a diversified investment portfolio. The image professional, like a realtor or a consultant, prioritizes modern aesthetics and absolute reliability. They accept a perpetual monthly payment in exchange for client credibility, 0 repair downtime, and potential business tax write-offs. Neither path is wrong. Value is determined by your individual priorities. whether that is pure return on investment or complete peace of mind. Respect the depreciation curve, calculate your actual true cost of ownership, and execute your choice with total financial awareness.